Your first Medicare bill may not match your expectations. For many retirees, Medicare feels like a financial relief. After decades of rising employer premiums and deductibles, the idea of government healthcare sounds simple and affordable. Then the first bill shows up, and often it's much higher than you originally expected. This surprise isn't a mistake. It's the result of rules most people don't understand until it's too late. Income lookbacks, IRMAA surcharges, enrollment timing penalties, and income spikes that quietly raise premiums years later. In today's video, we're going to talk about the cost of Medicare and how it shocks most new retirees, why this shock happens, how IRMAA really works, where modified adjusted gross income traps catch retirees off guard, and how smart income smoothing can help keep your healthcare costs under control for the duration of your retirement. Before we dive into all that, my name's Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm where my team and I help clients nationwide make smart money decisions. Let's jump into the video. Medicare's not one price fits all. The biggest misconception about Medicare is that everyone pays the same amount. In reality, Medicare premiums are means tested. Your income determines what you pay, and higher income retirees can pay 2 or 3 times more than the base premium for the same coverage that someone else is getting. The shock typically comes from 2 places. First is Medicare uses a 2-year income lookback, not your current income. So what happened in 2024 will affect what you're paying this year. And then also, many retirees have common retirement moves that temporarily inflate income without realizing the downstream effect of this. So you might retire, cut your income in half, and still receive a Medicare bill that is based on your highest earning year. That's not a good look for you heading into a fixed income state in retirement. So here's the basics of what Medicare actually costs. And let's start with a baseline. Most retirees are going to pay for Part A, and this is typically free, assuming you've worked long enough. And where the premiums come in is with Part B and Part D. And Part B is a monthly premium, and this is where your surprises will start. And then Part D is based off of your prescription drug coverage that you need, with income-based surcharges on top of that as well. In 2026, the standard Part B premium is roughly $203 per month per person. So for married couples, you're looking at about $405 a month just for baseline coverage. But that's only for retirees below a certain income threshold. Once your income threshold crosses a little bit higher, Medicare will apply IRMAA, or income-related monthly adjustment amounts, which stack on top of your base premiums. And IRMAA applies to both Part B and Part D, and that's where things can get really expensive really quickly. So how does IRMAA really work? Well, IRMAA is triggered when your modified adjusted gross income, or your MAGI, from 2 years ago exceeds certain limits. And modified adjusted gross income includes your IRA and 401k withdrawals, Roth conversions, capital gains, dividends and interest, rental income, and tax-exempt municipal bond interest. For married couples filing jointly in 2026, IRMAA's surcharges begin around $218,000 of modified adjusted gross income, and for the single filers out there, it's half that amount at $109,000. Cross that line by even $1, and your Medicare premiums jump for the entire year. This is the cliff retirees don't see coming. IRMAA is not phased in smoothly, it's bracketed. $1 extra can cost you hundreds or thousands more in premiums over the course of the next year. But why are new retirees especially vulnerable to this? Well, the first few years of retirement are when IRMAA's shock hits the hardest. That's because many retirees experience income spikes right before or after Medicare enrollment. Common triggers include large Roth conversions, selling a business or investment property that realizes huge capital gains, one-time capital gains in your brokerage account, deferred compensation payouts, large IRA withdrawals to reset finances, and required minimum distributions that may be starting if you're of that age. And here's the problem. These moves may be smart from a long-term tax perspective, but they can drastically increase Medicare costs 2 years later, especially if they're not planned for. So you may think, my income is low now. Why is Medicare so expensive? The answer is pretty simple. Medicare is billing you for the decisions you made 2 years ago, which might have no impact on your finances in any other way except for this IRMAA adjustment. Now we're going to go over some of the more common traps that I see retirees make when it comes to Medicare enrollment. The first is the enrollment period itself. And this is a surprise that happens when you enroll for Medicare, but you don't do it at the right time. So if you sign sign up for Part B coverage, but you don't do it during your initial enrollment period, and you don't qualify under a special enrollment period, you can face lifetime penalties. The penalty for late Part B enrollment is 10% for every 12 months that you delay, and that penalty never goes away. It's always stacked on top of your premium. Now, retirees often miss this because they assume that COBRA coverage counts as active coverage when it doesn't. They may miss a deadline during a job transition. They delay retirement while waiting for retirement paperwork, or they're not coordinating Medicare with employer coverage correctly. These mistakes don't just cost money once, they raise premiums for life, so this gets really expensive. There's also some modified adjusted gross income traps that most retirees don't realize. Many retirees assume only income matters, but Medicare looks at your modified adjusted gross income, which includes items most people forget about. And some of the biggest traps here are Roth conversions because they're fully included in your modified adjusted gross income. Even though they're a smart long-term solution to a financial predicament, especially for those of you who have a bunch of money saved in traditional 401ks and IRAs, they can spike income and trigger IRMAA for a year that 2 years later you'll pay the consequences of. There's also capital gains. Selling appreciated investments or a business even once can push you into a higher IRMAA tax bracket. So make sure that if you're selling gains or selling a business and coming close to a threshold, you're offsetting those gains with losses in your brokerage account through tax loss harvesting. You also might be forgetting about your municipal bond interest, which is sold as a tax-free investment, and it is under the ordinary income tax schedule. But most retirees and even some financial advisors don't realize that the interest earned on your municipal bonds is included under your modified adjusted gross income, and just $1 over that threshold, well, you know the result is going to cause you money in extra premiums 2 years down the line. And then finally, there's required minimum distributions. And once RMDs start, your income floor raises permanently, making IRMAA harder to avoid unless you planned ahead. This is where Roth conversions and income acceleration early in retirement, specifically around the age of 62 or 63, for those of you who have retired that early, come into play. And these traps don't mean you should avoid these strategies. Oftentimes they're still good, and sometimes it does make sense to trip an IRMAA bracket for a year for the greater good of your plan, but they mean you must sequence and smooth your income intentionally to help make sure they don't become a permanent problem. Now I want to dig a little bit more into this look-back problem, and here's where frustration typically sets in for clients. Let's say you retire at 65. You drop from $300,000 of income to $80,000 worth of income, and you roll in Medicare expecting low premiums. But Medicare is going to look at your income from age 63 while you were still working. So your first 2 years of Medicare, you pay the maximum or near the maximum in premiums, even though your current income is much, much lower. This feels unfair, but that's just how the system works. But there is good news. There are ways to fix this in legitimate cases. So the first thing you want to do is consider an appeal for IRMAA under your retirement guidelines. So if your income dropped due to a life-changing event, you may be able to qualify for an appeal using Form SSA-44. And a qualifying event includes things like retirement or reduction in work hours, passing of a spouse, divorce, loss of an income-producing property. If they're approved under one of those circumstances, Medicare can adjust your premiums based on current income instead of the 2-year look-back. However, not all income changes qualify. For example, voluntary Roth conversions do not qualify, nor do investment gains. This is why planning before retirement matters a lot. Appeals are not a safety net for poor timing decisions. Before we jump into some strategies we use to help our clients, I wanted to take a minute to thank you for watching. I also want to encourage you to schedule a consultation to meet with an advisor here at Nav Wealth to help not just on your Medicare plan, but on your financial plan overall. The link is in the description below. The beginning of the year is the perfect time to make sure you have all your financial ducks in a row. If you're contemplating retirement or looking for some guidance, we would be more than happy to have a chat with you. And if you're not quite ready for that yet, please make sure you subscribe to the channel and throw this video a like. We pump out content like this weekly, and I'm sure you will find it valuable. Now let's jump into the strategy. And the strategy is income smoothing. This is the most effective way to avoid Medicare cost shocks, and it's not appealing it after the fact, but income smoothing before or after retirement can really go a long way to making sure you pay as little in IRMAA surcharges as possible. And income smoothing means that we're spreading income across multiple years to stay below IRMAA thresholds whenever possible. And here's how smart retirees do it. First, they spread Roth conversions over many years. Instead of one massive conversion, they convert smaller amounts annually to fill lower tax brackets without crossing that IRMAA cliff. Next, they'll use their taxable accounts strategically, withdrawing principal from taxable accounts early to fund spending without increasing their modified adjusted gross income. They're also harvesting capital gains carefully. They're realizing capital gains up to the 0 or 15% capital gains brackets and not all at once. And furthermore, if they are realizing gains, they're also offsetting those gains with losses, which helps reduce your modified adjusted gross income. The fourth thing that they're doing is they're delaying Social Security. Delaying benefits keeps provisional income lower in early retirement, creating more room for conversions and withdrawals without triggering IRMAA. It also could help you down the line keep your Social Security taxable at a lower rate, specifically the 50% rate or the 0% rate, as opposed to the 85% inclusion rate. Finally, if you're of full retirement age and you're taking qualified charitable or you're taking required minimum distributions, you can take a qualified charitable distribution, which reduces your RMD dollar for dollar, and that balance doesn't hit your modified adjusted gross income. It's essentially a tax-free withdrawal that's given directly to a charity to help keep your modified adjusted gross income low, further helping you to reduce the chances that you hit that IRMAA surcharge. So we know that Medicare costs don't exist in a vacuum. Higher premiums often coincide with higher income tax brackets, increased Social Security taxation, and reduced deductions and credits. This creates a stacking effect where $1 of extra income costs far more than expected when you combine taxes and Medicare premiums. That's why retirees are often shocked when they realize the true marginal cost of extra income can exceed 40 or 50% in certain years. Avoiding these cliffs is one of the most valuable services financial planning provides. Let's just go over a brief practical example. Let's consider a couple who's 65 and retiring. They have $1.5 million in IRAs, $400,000 in taxable accounts, and they're planning Roth conversions to reduce future required minimum distributions. If they convert $200,000 in year one, they may jump multiple IRMAA brackets. Their Medicare premiums increase by several $1,000s 2 years later for each of them, and the conversion may still make sense, but the timing didn't make sense. So if instead they convert $40,000 a year over the next 5 years, they're more likely to stay in below the IRMAA thresholds, reduce future required minimum distributions, and maintain predictable healthcare costs throughout the duration of their retirement. That's the same strategy, but a very different outcome. So what's the bottom line here? Well, Medicare is one of the most misunderstood parts of retirement, and the cost shock, it's not accidental. It's the result of rules that punish poor timing and reward coordinated planning. To avoid surprises, you want to understand IRMAA and the 2-year look back, know what counts towards modified adjusted gross income, enroll on time and avoid lifetime penalties, smooth income across years, and use Roth, taxable, and charitable strategies intentionally. Medicare doesn't have to be a financial setback, but it does require planning before the first bill arrives. If you want help modeling Medicare costs alongside taxes, Social Security and withdrawals, and building a plan that avoids IRMAA cliffs, that's exactly what my team does here at Nav Wealth Partners. Thank you so much for watching, and as always, make smart money decisions.